Hello and welcome to the LSR Weekly View. What else could we talk about this week other than, of course, the UK referendum? Now, a few weeks ago, we outlined what is the most usual market response to these set-piece political events, and which most recently played out in the event of the Scottish referendum. We're looking for a moment of maximum investor fear shortly before the event, and then a risk rally as the status quo outturn becomes more likely. Now, the precise details of these various political events obviously vary, but this pattern has broadly played out again this time around. The moment of utmost fear was clearly around the beginning of last week, and then we've had a risk rally over the last few days. Now, we've been positioned for this, as you would expect, and we've been long sterling since May the 18th against the euro. We had an entry level there of 78. At the time of recording, we were at around 76.5. And we think that in the event of the Remain vote, that we expect that could go further and move that cross rate to around 70. Now, that would be an overshoot and a time to take profits, but we could get there very soon after a Remain vote being announced. On sterling dollar, we don't actually have an active position, but the equivalent sort of overshoot level in cable we would put at something like 155. Crucially, though, we need to contrast that near-term bounce in sterling with a much more bearish longer-term view for the currency, which is grounded in our macroeconomic analysis. The referendum, irrespective of its outturn, frankly, has already caused a severe dent in business investment growth. We saw that as early as the fourth quarter of last year, and it's continued and probably exaggerated in the first and second quarters of this year. Now, that injection of business investment uncertainty that the referendum represents has happened at sort of a uniquely bad time in the UK cycle. The household savings rate, unlike in the US, where the household savings rate is higher than we would expect it to be and is increasing. In the US, the household savings rate is lower than we would expect it to be. It's lower than its levels immediately before the 2008 crisis. And so what that means is the consumer cycle in the UK is exhausted, and consequently any shocks to income that households receive are likely to be reflected one for one in spending. So that buffer, that sort of safety net that growth has in the US does not exist in the UK. Now, we would hope that at this point in the cycle, business investment would take over as the driver of growth, but the referendum may have short-circuited that. So if you were worried about an economy where the central bank ran out of time to increase interest rates before the cycle came to an end, then it's probably the UK where that fear should be greatest, not the US. And the referendum, as I say, irrespective of its outturn, has increased the likelihood of that happening. So when we talk about being positive about sterling sort of late this week going into next week, I think it's often what currency traders might refer to as a round of applause rally. But no matter how good a show has been, rounds of applause always end. In this instance, though, Brexit or the result of the referendum isn't the end of the story. Crucially, it's one of the first instalments in a theme that's going to dominate markets for at least the next year. Even in the event of the Remain vote, the Remain outturn that we expect, European political risks aren't going away anytime soon. On Sunday, we get the second Spanish general election in 8 months. The last general election in December 2015, produced results that didn't produce either a minority or at least a coalition government. So that election is being rerun. We have an Italian referendum on constitutional reform in October. The French presidential election is May and April 2017, and in around a year's time we get the German general election. And if even all that wasn't enough, then of course in the middle of it, in November, we get what's likely to be a very unusual US presidential election. So there's plenty to keep us sort of biting our nails over the next 12 months or so. Now, of course, all these events have their unique political characteristics, but as we navigate them as investors, I think it's useful to remember that usual pattern that risk assets often follow and that we outlined at the beginning of this piece. Look for the moments of maximum perceived risk, a week or 2 weeks before the event, and then a relief rally as investors come to the conclusion that the outturn, whatever it is, probably isn't the end of the world after all, and risk assets can recover somewhat. So thank you for watching, and we'll see you next week when we know the result.